One thing I find fascinating about real estate right now is all the different data sources and how they are somewhat conflicted, or at the very least don't really tell the same picture. And what I mean is, it seems like every week we have a new set of real estate data that comes out and that talks about the housing market, how much different markets are going down, so much and so forth. And the most recent example is the data that came out from Moody's Analytics is different from the Redfin data, and the Redfin data is different than Zillow's data, and Zillow's data is different than the Fred data, and so on and so forth. And so because we have all these different data sets, I feel like it's very difficult right now for the average person, or really even seasoned professionals, to kind of get a true picture of what's happening in the market. But what we can do is look for consistencies and similarities between these different data sets in order to see, are there any similar trends that we can pay attention to in all these data sets that will start adding up to showing what the real picture is. And to me, the overall trend is that prices are coming down, at least on the national average. You can see this in Redfin data, you can see this in Zillow's data, you can see this in Moody's data, you can see this in Fred's data, you can see it in the Case-Shiller Home Price Index. Like pretty much every single data source that we have that tracks the housing market is showing that home prices nationwide right now are starting to come down. But the amount and the percentage is where you start getting a lot of these discrepancies. So for example, if we look at Moody's most recent report, they're showing that Coeur d'Alene, Idaho is down by the most. This is the housing market that has sunk the lowest right now over the past several months. And they're saying that they're down by 10.8%. However, I did a video a little over a week ago talking about all this data from Redfin, and Redfin's data shows that the housing market that's in the worst shape is probably Austin, Texas, where they're down over 18% right now from their peak in June. So to me, it seems like these data sets are not really tracking everything in the same way for some reason. But what we can look at is Austin, Texas on Moody's list here. And sure enough, they are, because you have Coeur d'Alene, Idaho being the most at 10.8% down from their peak in 2022. And then the next on the list is San Jose, down 10.6%. And then Austin is right there, third on the list, saying that they're down 10.4%. My question is though, how did they go from a 10.4% decline to an 18% decline in the different data sets? I mean, that's a pretty big inconsistency, right? What I think we can all agree on is that both data sets show that the numbers are down. And that's what I really want people to focus on here. And because we have these discrepancies in the real estate data, a lot of people also say, well, this isn't happening where I live, Michael. Where I live, prices are remaining high. You know, properties are still selling within a week of being listed. And that might be true. I'm not here to dispute that. I'm not here to say that you're wrong and that your market is not still hot, because it very well could be. But I think it's also important for people who say this to understand, why is your market still hot? What's happening where you live that's not happening in other places? And I think the more everyone understands these things, the better off people will be when it comes to figuring out what's happening into their local market. So if you are one of these people that says, hey, you know, sales are still flying off the shelf in my area, prices aren't coming down, there's even still bidding wars, etc. If that's you, then your market probably has a couple of these key characteristics. Number one is that the demand to live where you live is still very high, and likely inventory is probably still quite low. That's the first thing. The second thing is that it's very likely that where you live, home prices are still relatively affordable compared to what people can earn for their hourly wages, and the amount of money that people make in your area still makes enough sense where people can afford to buy a home in the area, keeping things moving along pretty strong. And it might be one of those things, it might be both of those things that's keeping your area relatively hot while a lot of these other areas are completely cooling down. But this is what everyone needs to recognize. There are plenty of areas right now where home prices have fallen 10% or more since June of 2022. Okay, it might not be where you live, but there are places this is happening, and that's why I bring this up on the channel, because first of all, this can highlight where the most opportunities might come from in the next couple of years when it comes to buying in areas that are seeing huge price cuts. And the other reason to bring this up is because when we're starting to see all these other markets fall right now by 10% or more, and it's not happening in your area, that doesn't mean that there is not potential for it to happen in your area. And that's an important thing I want everyone to realize, because just because you're not seeing it happen yet doesn't mean that it won't at all. Because as we get deeper into the recession, and as the Fed continues with their rate hikes, and after that probably keeping the rates high for an indefinite amount of time, that can be enough to make unemployment in your area go up. That can be enough to force people to sell their homes that maybe not otherwise would have sold. And that can change the market dynamics. So even though you're not seeing it happen right now, it's not a guarantee that it won't happen over the next couple of years. And that's something else that everyone else needs to understand. And based on everything I've said already, you've probably realized that I am a realist, guys. I look at things for what they are, okay? I'm not trying to pump the housing crash. I'm not trying to tell you that housing's going to go to the moon. I'm not on either side of this, but all you have to do is look at where the data is taking us, and every single index out there is showing national home prices coming down, and some areas are getting hit a lot harder than others right now, and this is just the beginning. But you can be guaranteed of one thing, that if you ignore this data and you don't pay attention to the overall trends and where things might be going in your market, then you're setting yourself up for failure if you're a home buyer or a home seller looking to get out at the right time, or someone who's looking to basically get into a home at the right price. Because if you're not paying attention, it also means that you're not going to be able to recognize a good deal in your neighborhood. It means you're not going to be able to recognize when's going to be the best time to get into the market for where you live. And it also means if you're a seller, then you'll likely miss the best time to sell, which arguably is probably already passed in most places. But obviously, if you live in an area where it's still hot, now is still your chance, guys. Now let's talk about HELOCs, or home equity lines of credit, for a minute. This is something we've covered a little bit here on the channel, and check this out. This week, home equity lines of credit interest rates just hit their highest level that they have in over a year. And right now, if you want a 10-year HELOC, the average rate is 7.37%. And if you want a 20-year HELOC, the rate is 7.92% right now, guys. And here's the interesting thing. The amount of HELOCs that people are taking out is going up. And I find this fascinating because this is a pretty high rate. You're talking very close to 8%. I mean, these rates are higher than most personal loans that you can get, first of all. And really the only type of loans that are higher than this are those, payday loan places and credit card interest rates, things like that. And if people are willing to stake their homes in order to take out these home equity lines of credit right now at these interest rates, I feel like that's a warning sign that something is fundamentally going wrong in the housing market right now. And that's most likely the fact that people are broke, okay? People are not going to be borrowing against their home at an 8% interest rate unless they really need the money. What kind of investment can you use the money for right now? I've heard people say, oh, I'm going to take it, I'm going to buy another property, whatever. Oh yeah? Where are you going to get a return right now on an investment property that pays well over 8% to actually net you a profit? Tell me where that is right now, guys, because I want to know, I want to buy it too. And that's why I think all of this is such a joke right now, because when you have HELOC rates in the 8% range and people are taking this and saying that they're using it for an investment, or I'm going to, remodel my kitchen, why don't you just take a personal loan? Those are 7%. Why don't you just borrow against your 401k? That'll be even lower. Why don't you have the money saved to begin with and don't even need the loan? Those are the questions that I'm asking, because to me, this is all just further proof that things are not going well right now for most people who are taking out these loans, and is likely going to lead to people defaulting on them, because if they're drawing money out of their home in order to pay for things that they can't afford right now, it's only going to be a matter of time before they end up losing their home because they can't pay for this home equity line of credit. I don't wish that on anyone, but I think it's important to acknowledge what's really happening here, guys. You know, it's not like I want anyone to lose their home over all of this, but I'm giving you guys a heads up not to fall into this trap, because you're going to see people wish they wouldn't have done this right now in a time when inflation is still uncertain and we don't know how much things are going to cost here in 2023. So the more you play games with the biggest asset you probably own and risking, you know, having a roof over your head right now, to me, sounds like the most dangerous and risky thing that anyone can do besides just, you know, jumping off a bridge or whatever. Now, I don't know if this next story could be part of this problem or not, but it's worth bringing up because I thought it was interesting at the very least. And there was a story from Bernie Marcus, who used to be the CEO, and he was one of the co-founders of Home Depot. And he came out and said that people just hate capitalism now, and everybody is looking for socialism. You know, nobody wants to work. Nobody gives a damn. Just give me money, send me money. I don't want to work. I'm too lazy. I'm too stupid, etc. This was what he said. And I thought it was interesting because it kind of points out what's going on today in terms of, ever since we had the lockdowns and all the stimulus sent out, I feel like it changed the workplace dynamic and what people are willing to do for work pretty much forever, guys, at least if not for the foreseeable future. Because it's not like he's just making this up. You know, you've seen a lot of companies that have had to get rid of people over this. Like, for example, the company Better.com, they're an online mortgage company. And last year they had to fire over 900 employees because they weren't being productive and they weren't working long enough, they weren't working hard enough, and they considered that these people were stealing from their company because of that. They're coming out and blaming the younger people in the workforce, saying that the younger ones are very entitled and they don't want to work and they've never had to sacrifice, so they don't know, you know, what real hard work is. And maybe there's some truth to that, but the flip side of the argument that they point out is it's not just that. That's part of the problem, but the other half of the problem that needs to be acknowledged is a lot of people in the older generation, when we had these lockdowns starting, the economy was taking this huge unknown turn, a lot of people decided to take early retirement. So you have people who are already looking at retiring soon anyways, able to take an early retirement because of the stock market doing extremely well up until 2022 anyways. And then you had people, you know, quitting their job for a different job or starting their own business, different things like that. Of course, you're going to have the younger generation blame it on the older ones, and the older ones are going to blame it on the younger ones, whatever. Doesn't really matter. But I find this interesting because I think this is part of the reason why we're starting to see more people take HELOC loans right now. I think it's part of the reason why people don't want to look at what's happening in their markets, because they just see these things and they just want to blame somebody else right away, or they want to just attack someone and right away think that everyone else is wrong and that they know better. I think what all of this can teach us is that there are many different factors at play of why there are a record number of jobs available. There's many different factors at play of why your housing market might not be going down, or it has already gone down over 10%. Just keep all this in mind, guys, because the minute that you think you know everything, you've lost, you know? One thing I love about the internet, and especially YouTube nowadays, is I have learned how to do so many things that I've always wanted to learn how to do, and for free. And that's amazing, you know? And I consider myself a lifelong learner. I never get bored of discovering something new or learning a new skill. And I think that's what people need to be doing in an environment like this, because the world is changing faster than ever. The moment that you think you know everything, you know nothing. because probably it has already changed from what you thought you knew. And here's something really interesting about what's happening with the job market right now. Remember how we've talked about a bunch of times that the Fed said that they want the unemployment rate to go up, right? Well, here's something interesting about that. There were 10.5 million job openings as of November of 2022, and this is one of the highest amounts on record. And since the Fed wants to basically increase the unemployment rate by raising interest rates, what do you think is going to happen, guys, into 2023 here? Now that we're in the new year, now that we have basically almost a record amount of jobs available, do you think the Fed's going to pivot and turn around and stop raising rates when we have so many jobs available and unemployment still relatively low? Not likely. But let's look at this for a minute. Even though we've been seeing all these stories about layoffs happening left and right, there was 1.3 million layoffs just in the month of November alone. But you know what's interesting about that is it's still one of the lowest numbers on record going all the way back to the year 2000. This is why I keep saying on the channel that you haven't seen anything yet in terms of where the interest rates are, in terms of the amount of layoffs and the amount of people that could potentially lose their jobs, because all these numbers, as crazy as they sound, they're still nothing compared to where they could go as we get deeper into the recession. That's what people need to understand about this. And just like we talked about the other day in the video about Michael Burry's prediction, the only thing that could basically turn all this around, guys, is if the government goes back to introducing more stimulus into the economy and the Fed reverses their current policy, pivots and goes back to QE and starts reducing interest rates. If all those things happen, we're not going to see the mass layoffs and things like that happen. But instead, we're going to have a whole new set of problems when it comes to the value of our currency is going to be completely trash. We've already lost over 96% of the dollar's purchasing power since the early 1900s, guys. So it's already worth basically nothing compared to what it used to be. But if they do this, then they're going to bring that to, we've lost 100% or more than 100% of its value, because this is not sustainable. But before we go, I have some good news for you guys, and that is if you're a renter who has been struggling when it comes to the rental increases and not being able to find a nice place to live, just in 2023 alone, there's an estimated 917,000 new apartment units going to be delivered nationwide over the course of 2023. And if you're a renter, this is great news, because not only is this going to give you more choices, but it will help alleviate the pricing of the rentals in your area. And regardless of what all happens with the Fed and the government and all of this is still going to be good news for anyone who needs a place to live right now. And I think we can all celebrate that it's going to be getting a little bit easier finally, hopefully later this year, for a lot of people. So if you ask me, that's a win. If you guys enjoyed this video, make sure you click the bell notification down below. YouTube will alert you every time I post a new video. And if you don't want to wait, check out my next one on the screen right over here, and I'll see you in the next one.